I invested my first $1,000 at 22, and it's now worth $1,947. But I made three critical mistakes that cost me hundreds of dollars. In this video, I'll show you the exact step-by-step process to invest your first $1,000 the right way, so you don't make the same mistakes I did. Let's get into it. Hey, welcome to 20 Finance, where we simplify personal finance for people in their 20s. If you're new here, I break down investing, budgeting, and money management without the confusing jargon. Today, we're covering everything you need to know to invest your first $1,000. Whether you just got your first paycheck, saved up from a side hustle, or received a gift, this guide will show you exactly where to put that money and how to make it grow. Before we start, quick disclaimer, I'm not a financial advisor. This is educational content based on my research and personal experience. Always do your own research before investing. First, why should you even invest? Can't you just save in a bank account? Here's the problem. Inflation in 2026 is around 3.4% per year. That means your $1,000 in a regular savings account, earning maybe 0.5% interest, is actually losing buying power every year. Let me show you the math. $1,000 in a savings account at 0.5% interest. $1,005 after 1 year. But with 3% inflation, you'd need $130 to buy the same things. You're actually down $25 in purchasing power. Now compare that to investing. $1,000 in the S&P 500 has historically returned about 10% per year on average. After 1 year, $100. After 5 years, $1,610. After 10 years, $2,590. That's the power of compound growth. Your money makes money, and then that money makes more money. So the real question isn't, should I invest? It's, how do I invest the right way? Step 1 is choosing where to invest. You need a brokerage account. Think of it like a bank account, but for stocks and investments. Here are the 3 best options for beginners in 2026. Number 1. Fidelity. Why I like it? Zero commission trades, great research tools, and excellent customer service. Best for people who want everything in one place. Minimum investment, 0. App rating, 4.8 to 5. Number 2. Vanguard. Why it's popular? They literally invented index funds, lowest expense ratios. Best for long-term buy and hold investors. Minimum for mutual funds, $1,000. Perfect for this guide. App rating, 4.65. Number 3. Charles Schwab. Why it's solid. No account minimums, great mobile app, lots of educational resources. Best for mobile-first investors. Minimum investment, 0. App rating, 4.75. My recommendation? If you have exactly $1,000 and want simplicity, go with Vanguard or Fidelity. Both are trusted, established, and perfect for beginners. Here's how to open your account. 1. Go to their website. I'll link everything in the description. 2. Click Open Account. 3. Choose Individual Brokerage Account. This is a regular taxable account. 4. Fill in your personal info. Name, address, social security number. 5. Link your bank account for transfers. 6. Wait 1 to 3 business days for approval. Note: if you're under 18, you'll need a parent to open a custodial account for you. Okay, your account is open and funded. Now the big question, what should you actually buy with that $1,000? Here's what I recommend for 99% of beginners: index funds. What's an index fund? Instead of buying one company's stock like just Apple or just Tesla, an index fund is like buying a tiny piece of hundreds of companies all at once. The most popular one is an S&P 500 index fund. The S&P 500 tracks the 500 largest companies in America: Apple, Microsoft, Amazon, Google, Tesla, and 495 others. Why this is perfect for beginners. Diversification. If one company fails, you still own 499 others. Low risk. The entire U.S. economy would have to collapse for you to lose everything. Low cost. Expense ratios as low as 0.03% per year. Proven track record. 10% average annual return over the last 50 years. Hands off. Buy it and forget it. Here are the exact funds to buy with your $1,000. Option 1. VOO, Vanguard S&P 500 ETF. Tracks the S&P 500. Expense ratio, 0.03%. Current price, $500 per share. You can buy 2 shares with $1,000. Option 2. VTI, Vanguard Total Stock Market ETF. Tracks the entire U.S. stock market, about 4,000 companies. Even more diversified than S&P 500. Expense ratio, 0.03%. Current price, $270 per share. You can buy 3 shares with $1,000. Option 3. VTSAX, Vanguard Total Stock Market Index Fund, mutual fund version. Same as VTI, but it's a mutual fund, not an ETF. Minimum investment, $1,000. Perfect. Expense ratio, 0.04%. You invest the full $1,000, no leftover cash. My pick for your first $1,000, VTSAX or VTI. They're essentially the same thing. Total U.S. stock market exposure. Now let me show you how to actually place the trade. All right, you've transferred $1,000 into your Fidelity or Vanguard account. Here's how to buy. For ETFs like VOO or VTI, 1. Log into your brokerage app. 2. Search for the ticker symbol, VTI or VO. 3. Click Trade or Buy. 4. Choose Market Order. This means buy at current price. 5. Enter number of shares. Example, 3 shares of VTI box, 810. 6. Review and confirm. 7. Done. You're now an investor. For mutual funds, like VTSAX, 1. Search VTSAX. 2. Click Buy. 3. Enter dollar amount, $1,000. 4. Choose Market Order. 5. Confirm. 6. Your order will process at end of trading day. Important. The stock market is only open Monday, Friday, 9:30 a.m. to 4 p.m. Eastern Time. If you buy outside these hours, your order will process the next trading day. And here's something nobody tells beginners. You might have some cash left over. If you buy 3 shares of VTI at $270 each, that's 810s. You'll have 190 left. What do I do with leftover cash? Either let it sit and add more money next month to buy another share, or buy a fractional share if your brokerage allows it. Fidelity and Schwab do. Vanguard doesn't for ETFs. Now, the 3 mistakes I mentioned at the start. Here's what not to do. Mistake number 1. Trying to time the market. When I started, I waited for a dip to invest. I waited 3 months, and the market went up 15%. I lost potential gains trying to be clever. The truth? Nobody can predict the market. Just invest as soon as you have the money. Time in the market beats timing the market. Mistake number 2. Checking your account every day. I used to check my portfolio 5 times a day. On red days, I'd panic. This is a recipe for bad decisions. Remember, you're investing for 10, 20, 30 plus years. Daily fluctuations don't matter. Check it maybe once a month max. Mistake number 3. Selling when it drops. The first time my $1,000 dropped to $950, I almost sold everything. Thank God I didn't. Here's the secret. The stock market always goes up and down. In 2022, the market dropped 18%. In 2023, it went up 24%. If you sold in 2022, you'd have missed the recovery. The strategy? Buy and hold. Don't sell for at least 5 to 10 years. Let compound growth do its magic. So you've invested your first $1,000. What now? Here's what to expect. Month 1 to 3. Your investment will probably go up and down. Maybe it's $1,350, then $980, then $1,000. This is normal. Do nothing. Year 1. Historically, You could be anywhere from $900 to $150. The average would be around $100, 10% return. Year 5. If you never add another dollar and just let it grow, around $600. Year 10. Around $2,600. Year 30. Around $17,000 from just one $1,000 investment. But here's the real game changer. What if you kept adding? If you invest just $100 more every single month, after 10 years, $20,500. After 20 years, $76,000. After 30 years, $217,000. That's how you build real wealth. Start with $1,000, then keep adding consistently. All right, let's recap. 1. Open a brokerage account, Fidelity or Vanguard. 2. Invest in a low-cost index fund, VTI, VOO, or VD-SAX. 3. Buy and hold for the long term. 4. Avoid the 3 big mistakes. 5. Keep adding money when you can. That's it. Investing your first $1,000 doesn't have to be complicated. If this video helped you, hit that subscribe button. We post new personal finance videos every Tuesday and Saturday. Drop a comment below. What's your biggest question about investing? All the links to brokerages and funds are in the description. Thanks for watching, and I'll see you in the next one.